Welcome back. Now joining us for a look at the equity space is Mabyanine Phiri from xs.com. Mabyanine, thank you so much for joining us today. Now, global markets might have ended the first quarter on a positive note, but we've seen mixed trading coming into the second quarter. It just seems that markets were struggling to kind of make a stable post some stable gains over the past few days. Today, however, things have totally turned. Just take us through what you've made of trade in the first week of the second quarter.
Yeah, so a big influence, obviously, on today's markets activity stems from the recent FOMC meeting. Yesterday, we obviously got insight from the Federal Reserve Chair, Mr. Powell. Basically, there's still a lot of evaluation needed regarding inflation, which might take a while, potentially pushing back that whole topic of interest rate cuts. Nevertheless, from what we got yesterday, the possibility of a rate cut is still very much on the table. Investors are now obviously eyeing the chance of mid-year rate cut in June, with around about 60% of the likelihood of that happening. There are also some investors obviously awaiting tomorrow's non-farm payroll job report coming from the US for further hints in terms of the rate cut. So just a quick glance, I mean, looking on the market front locally, the JSE all share up today, increasing by more than 1.5%. In the US, futures of the S&P 500 and NASDAQ also rising by nearly 0.5%. Again, in Europe, the stock 600 also went up by 0.2%. So look, I mean, generally we have had a positive reaction from the global markets with regards to yesterday's meeting.
Listen, I always love seeing green screens, but it is a tough balancing act for Fed policymakers. As you mentioned, sticky inflation. We've had a slower labor market. We also have very strong GDP out from the US. But it seems like those higher rates for longer will remain, and we will see those interest rates cuts later on in the year than we initially expected in the first quarter. That we expected from last year. Now, let's move over to the commodities markets. We saw oil prices hit 5-month highs, trading at about $89 a barrel yesterday. The last time I checked, it was sitting close to those levels, I think at $89. Do you think that oil still has more room to run, considering the geopolitical risks that are still at play?
Yeah, sure. So like you've mentioned, you know, oil prices reaching new 5 high months, you know, making monthly increases of about 7.7%. What I can say is this surge can be attributed mainly, you know, primarily to rising geopolitical tensions, notably in the Middle East, as you know, and speculation about a potential decline in oil supply from Mexico soon. Additionally, also, I think what's really driving the price is the decision by the OPEC Plus committee to prolong, you know, voluntary production cuts into the second quarter of the year is also impacting the oil markets. Given these factors, oil prices are especially sensitive to geopolitical shifts, particularly those coming from the Middle East.
So a tight supply market on that front. Another high we saw was the local unit, which made strong gains against the US dollar, sitting comfortably under that 19 Rand mark to the greenback. Mabyanine, what's your sentiment around the local unit, particularly because we still have some risk events coming up, that national election next month?
Yeah. Yes, so emerging markets, including currencies, you know, like our own rand, responded also favorably to these developments, particularly speaking of yesterday's Federal Reserve meeting, with the rand appreciating by approximately 0.4% against a depreciating dollar after the statements and the announcements and the comments. It's worth noting, though, that this has occurred against the backdrop of recent data revealing a contraction in private sector activities during March, primarily driven by pressures impacting both customer and consumer demand. Despite the challenges, economic environment indicate that the contraction in the private sector activity, the positive reaction in emerging markets, particularly in currency markets, suggests some resilience and optimism, amidst the uncertainties, especially also domestically.
All right. Now, there wasn't much company news out on Sense today, but something that caught my eye was the report that Discovery and Visa put together on spend trends rather that track consumers' spending habits. And one of the things I found interesting from that report was that online grocery spend grew 10%, fueled by more options and better delivery services. This just made me think of ShopRite's Checkers 60/60. Now, the sales on that front in the half-year period rose over 63%. 60/60 pretty much eating everyone's lunch at this point, right?
Sure. So I think the increase in online grocery sales, particularly in South Africa, reflects a growing trend towards digitalization and convenience in the retail sector. Factors such as improved connectivity, the growing use of mobile smartphones, and changing consumer preferences really are likely driving this shift, to be honest. Although a major factor, though, in my opinion, really has to be the pandemic that we all went through. I think it accelerated adoption of online shopping as people sought safer alternatives to traditional brick and mortar stores. With concerns about social distancing and hygiene, many consumers turned to online platforms to purchase essential goods like groceries. And South African retailers really adapted well to this and took the business opportunity. I like the trend because not only does it benefit consumers by providing them with more convenient shopping options, but also represents opportunities for retailers to expand their market reach and streamline their operations through digital channels.
All right, it'll be interesting to see how Checkers' competitors, your Pick n Pay ASAPs, fare as we move forward. But before I let you go, can you just give us your stock pick?
Yes. So very interesting. My stock pick recommendation is our ARC Investments. I find their fund to be well focused. It's also efficient and well diversified, which has proven beneficial in navigating the current challenging economic climate. As far as I know, the stock is trading around 500 cents per share. And just to dive a little bit more into that portfolio, my choice to back this stock is influenced by their investments in two businesses, TymeBank and Rain. These two businesses are strategically positioned to address two critical challenges that I think offer a significant business opportunity in South Africa. Number one being providing cheaper alternative data for internet usage. That's really a very big challenge for South African consumers. And secondly, promoting financial inclusion in the fintech era. The fundamentals of these two companies, particularly TymeBank, I think reminds me of Capitec Bank back in the 2000s. So that's actually based on that, that's my stock pick for today.
Mabyanine, thank you so much for your time and insights. ARC Investments, one to look out for. That was Mabyanine Phiri from xs.com.